Hi traders. As you can tell by the title of this video, I'm departing from my normal chart videos and instead I'm going to compare futures versus stocks. Based on some of the questions I've been getting about futures and thinking back to when I first started to explore futures trading, I decided to create this video to answer the type of questions I had and I think that most traders first have when exploring futures. And when I first started to create this video, I thought it would end up just being 5 to 6 slides. But the more I got into it, I realized that if I talk about topic A, I also need to talk about topic B, which led to topic C. And so this video just kept growing. This video is only meant to be an introduction into futures. So if you have any prior knowledge of futures or experience trading them, I don't think you're going to get much out of this video. I think to give futures its proper coverage, I would actually need to do 2, maybe even 3 videos. So you will not be an expert in futures after watching this video. I'm just covering futures at a high level, but hopefully it will be enough information that if futures sounds interesting to you, you can do further research to see if futures are right for you. The next 2 slides are just some basic info on what are futures, what purpose do they provide, and a brief historical timeline. So we'll start with what are futures. And the definition: a futures contract is a legal agreement to buy or sell a particular commodity, asset, or security at a predetermined price at a specified time in the future. Now, I have to admit that when I first started trading futures, I found it to be a little intimidating. Like, what does it mean by it's a contract and a legal agreement? What am I signing? Can I lose my house somehow? Futures are definitely more intricate than trading stocks. So while you can't lose your house per se, you can lose a lot of money. So you must be careful trading futures, just like anything else really. As traders, we are always speculating on the price of some asset going up or down, and you can use futures to speculate on that price movement. More on this later, but for now, let's just look at an example. So here's an example of why someone would buy a futures contract. So suppose a farmer plants his corn in the spring, but he's uncertain how much corn will go for in the fall. Will the summer be hot? Will there be no rain? A lot could go wrong. So he can lock in a price for his corn now in the spring by selling a futures contract that obligates him to sell a specified amount of corn at a certain price to be delivered on a specific date. With this example in mind, it really should be no surprise that futures have their roots in commodity products, where people who have something to sell can hedge or avoid price uncertainty via futures. So in this example, let's say the farmer sells a futures contract in the spring for $20 a bushel of corn. And what that does is he locks in that price now, but he's foregoing any gains if the price of corn were to soar in the fall. So let's say for some reason corn goes for $30 a bushel in the fall. So he foregoes that extra $10 because he signed that contract. But on the flip side, if corn is only going for $10 a bushel, he's still guaranteed his $20 a bushel because of the contract. So it's just a way for him to lock in a price that he wants in the springtime. All right, let's now look at a brief timeline of the futures trading exchanges just to show how long these have been in existence. So back in 1697, you had the Dojima Rice Exchange in Japan for rice futures. 1848, Chicago Board of Trade came on. 1882 was the New York Mercantile Exchange. 1877, England's first exchange called the London Metals and Market Exchange. And in 1972, the Chicago Mercantile Exchange came on. Now, just to clarify one thing, there's something called the Chicago Mercantile Group, which owns 4 major exchanges: the CME, the Board of Trade, the New York Exchange, and the Commodity Exchange. And the CME Group, it's headquartered in Chicago, and ironically, it was right across from the street where I used to work in my prior career before I became a trader. So it was kind of interesting that I used to walk right by that building, not knowing that one day I would be getting into the futures world. All right, just a brief history. So let's now move on to the types of future contracts that can be traded. And it can be kind of divided into two groups. You got the financial side and you got physical futures. On the financial side, you got stock indexes. So that's where the S&P, NASDAQ, Russell, those can be traded. You got currency markets, so that's your foreign exchange or Forex world. Interest rate products, that's where notes and bonds can be traded. Then on the physical side, you got energy, so that's going to be oil predominantly, also natural gas, gasoline, metals, got things like gold, silver, copper, and agriculture. You got things like corn, wheat, sugar, hogs. All in all, there are a lot you can trade in futures. All right, let's now look at the different size of the future contracts that can be traded. And there's three groups. So you got a standard size contract, a mini size contract, and a micro size contract. Futures are traded in one of these sizes, which is different from stocks. You know, when you buy a stock of Microsoft, for example, you just decide on how many shares you want to buy. But in futures, it's the size of the contract that says how much you are buying of some asset. This is one of those topics that I think I can make a video solely on contract sizes. So hopefully the following slides will bring this more into focus. Additionally, not all future contracts trade in these sizes. For example, the S&P futures contract originally traded only in the standard size. But in 1997, they created the mini contract to open up futures trading to more retail traders. And then later, they created the micro contract, which further opened up trading to retail traders. And then in 2021, they shut down the standard size contract, although it still exists due to people already having open positions in the standard size. So depending on which asset you trade, you need to look into what size contract is offered. The other thing about the size of futures contract is the amount of money you need to trade these. So a standard requires the most amount of money in your account to trade, followed by the mini and then the micro contract. A micro contract is 1/10 the size of a mini, thus requiring less capital to trade. So for example, to buy one ES mini contract, that requires you to have $400 to day trade it and 11,800. That 11,800 actually, I should say that's on the broker that I use. You have to check with the margin requirements on your broker, but they should all be in a general area to the ones I list here. So yeah, so it's 400 to day trade and 11,800 to hold that contract overnight. But one micro ES, the MES contract, that only requires you $40 because it's 1/10, right, the size of the mini. So it's only $40 to day trade one contract and 1,180 to hold it overnight. Since a micro contract requires typically 1/10 the capital to buy, then you will make 1/10 of the profit of every 1 point increment compared to a mini. So, you know, it's just 1/10, you know, so you can make or lose 1/10 what you can make or lose in a mini contract. So the math is pretty nice. All right, let's look a little bit more at contract sizes. So keep in mind the three sizes from the previous slide, the standard, the mini, and the micro. If you want to trade oil, crude oil, you can buy the standard contract, all right? That's known as CL for oil. And that represents you buying 1,000 barrels. Or you could buy the mini, which is QM. It's like a ticker symbol in the futures world, QM, and that is for 500 barrels. And then there's the micro contract, which is going to be 1/10 the size of the standard, and that's 100 barrels. So hopefully it would make sense that if you buy a standard contract, you can win or lose more money than the mini contract, and the mini contract can win or lose more than the micro contract. Let's look at how much each contract is worth. Okay, so we'll start with oil here. And the tick size for a standard contract is 1 cent per barrel. And the tick size says how many fractions are there to make 1 point. So the tick size is the numbers on the right-hand side of the decimal point, and it's just how many ticks are there to get one on the left side of the decimal. So since there's 100 pennies in to make up $1, then the tick value is $10. So 1 cent per barrel times 1,000 barrels gives you a tick value of $10. So now that's saying that when oil goes up 1 penny, you're going to make $10. And if it goes down 1 penny, then you're going to lose $10. And then the point value is just going to be the number of ticks. So you have 100 ticks times $10 gives you $1,000 for every point. So if oil is trading at, say, $70 and you buy 1 CL contract, and that contract goes from 70 to 71, then that's 1 point that it moved, and so you're up $1,000. And if oil were to go from 70 down to $69, then you would lose, or you'd be down $1,000. All right, so the math for the micro contract is, simply just 1/10 of the standard size contract. In oil and some other commodities, the mini contract is available, but due to very low trading volume, it's hard to trade because you might not be getting filled at the price that you want. So you need to always check the daily volume of a futures contract that you want to trade to ensure there's enough volume to easily get your trade orders filled. So like I've never traded this mini contract on oil, and the same thing applies in natural gas. I've only traded the mini contract in natural gas a few times, but it's just really hard because you might have a price target and it might get there, but your order might not get filled, and all of a sudden you have to, start chasing the price as it moves away from your price entry or exits. So just something to be aware of, that in commodities, the mini contract sometimes is not heavily traded enough, and so you're really left with just the standard or the micro contract. All right, and here we can look at a gold contract. So GC is the symbol, and the micro is MGC. And if you buy 1 gold standard contract, you're effectively buying 100 troy ounces, and the tick size is $10, and so you could just start to do the math. 10 times 100 every tick is worth $10, and a point means you go up or down $100. And the E-mini S&P is the ES, and the micro is the MES. And so for the mini, it's the size of the contract is simply $50 times the current S&P index price. So like right now we're just under 4,900. So you'd be 4,900 times 50. So that'd be, I don't know, something over $200,000 is what you're effectively trading. Now you obviously don't need to have that 200,000. You just need to have the margin requirements, which we're going to be talking a lot more about later on. But so the contract size, it's important, but it's almost really not in a way, because you're not, you don't care that you're buying 1,000 barrels. You're just buying the contract, and you're speculating on the price. So I just list this contract size just to give you an idea of like just how much you're effectively buying. But these are the really important numbers: the tick size and the point values and the margin requirements. And so for the ES, its tick size is 20 0.25, and so each tick then moves up $12.50, and so a 1 point move in the ES, so going from, let's say, 4,900 to 4,901 is $50, and going down is also going to be $50. There's this column over here, settlement, and there's two types of the way the futures contracts settle. They're either physically settled or cash, or also known as like financially settled. So physically settled means you're actually physically taking possession of whatever commodity or whatever asset you're buying. So, if you are like an oil refiner, like you would want to take physical delivery of 1,000 barrels. But for you retail traders out there, we don't want to take physical delivery. So, you just got to know that futures contracts, they're the contract, and they do expire, which we're going to be talking a lot more later. So you just got to be mindful of that expiration, because you don't want to take physical delivery. Now, I don't think there's any broker that would even allow you to do that. They'll be sending you reminders of upcoming contracts that you are in that are expiring, but just something to be mindful of, that these contracts, because they do expire, some would be physically settled or cash settled, which is just going to be you're going to realize a debit or credit to your account when they settle. Okay, so let's move on here. So here's just a chart just to show the number of futures contracts traded, and I showed this just to show the standard, the mini, and the micro, and how they kind of vary. So like on the S&P, you could see the numbers for the standard, in 2019 it was 1.1 million. 2020 went down to 1.5. 2021, which is that year that they stopped allowing it to be traded, and now it's down to 1.2. And there's still 900,000 contracts open, that people bought prior to the closing of it. So this number will, eventually be going down to zero. But here's the mini S&P, and you could just see, millions, 500 million, 400 million, 500 million, And then the micro has really been growing in popularity. So it started with 43 million in 2019. 2020 was a big year, a little dip in 21, and then in 22, it's getting almost as popular as the mini. So in the and I would think that the Nasdaq would have very similar numbers, or at least proportional to these numbers. But now when you move on to, let's say, corn, so here's the corn standard contract, and then the mini corn contract, and you can just see how the mini contract, it just falls off. So when you're trading like corn, you're really almost relegated to trading a standard size contract due to the volume, because the volume is so low on the mini. And here's like soybeans, and here's the mini contract, and the same thing. It just really falls off. And then we can even look at into like the FX world. So here's like the euro, so the standard size contract is quite large. The mini is substantially smaller, but the micro, I'm sorry, I skipped that too fast, but the micro was actually quite large. So that's why I'm saying like the mini size contracts, you really need to be careful there. Okay, so want to move on to understanding futures margin, and this screen is red for a reason, because I need to make this topic stand out, because understanding margin is crucial to trading futures. So futures margin is the amount of money you must have in your trading account when you open up a futures position. Futures margin is not how much money you are borrowing. So if you have ever used margin to trade stocks, you know that you can obtain some extra capital to buy or sell a stock, short a stock, and then you pay that fee to acquire that extra margin capital. Well, in the futures world, margin is totally different. It's just it just dictates how much money you need to have in your account. Now, this will make more sense when we start looking at some examples. But there are different kinds of margin. So as I highlighted a little bit before, there's the intraday or the day trading margin that we saw, and there's the overnight margin. Some brokers also call it initial or maintenance margin. So those are the margins, and we can look. So here is the margin requirements on my broker. I use a broker called AMP Global Clearing. And these are the margin requirements, and these are the two important columns over here. So here's the maintenance requirement and the day trading requirement. So as long as I have $40 in my account, I can trade the micro S&P. Now, in reality, you want to have a whole lot more than $40 in your trading account, because if price goes against you, you could all of a sudden, get a margin call. So, this is just the bare minimum. But like I said, you want to have a lot more. Now, to hold that contract, as I said before, past the maintenance margin, which I'm going to show the hours this all happens, but basically to hold it overnight or past the day trading hours, you need to have $1,180 in your account. And again, if you want to hold it, I would suggest having a whole lot more than just that amount. And so for the NASDAQ, you want to have one contract to trade during the day. You have to have $100 in your account. The maintenance margin here, 1770. Here's the Dow, the Russell. And then down here is the E-mini S&P. And as we talked about before, we saw that it's $400, so 10 times bigger than the micro. And you got 11,800 maintenance margin, again, 10 times the micro. And the NASDAQ is going to be also 10 times its micro, so it's going to be $1,000 to day trade and 17,700 to hold it past the day trading hours. Now, you always have to be mindful of these numbers, and they change frequently. So you always have to be aware of what your broker is setting these to. It's not, this isn't going to be what it is at the end of the year, most likely. It might not even be what it is next month. So you do have to be mindful of these numbers. Okay, so now let's look at these times of, oh yeah, I got this slide here. So we just look at some more margin requirements. So like on oil, so this is the CL, the standard size contract, day trading, 1650 to day trade it, hold it past the day trading hours is 6600. Like I said, there's is the E-mini, the mini size contract for oil, the QM, and it's obviously smaller margin requirements. It's just the volume is going to really be, it can be difficult. You might not get exactly the price that you want. So that's just something to be mindful. But here's the micro, which again is just going to be 1/10 the size of the standard. So 660 versus the 6600. Here's natural gas requirements. And again, they have an E-mini, but it's hard. Now there is a micro natural gas. My broker does not offer it, so I'm basically just left with a standard size contract. And we got the metals down there. Okay, so let's look on at the timing of the trading hours. So the CME has posted these times, and all the CME information you can find more information. It's at CME Group it's either .com or .org. I have another site coming up that'll specify it. But all of these numbers are times, and all the specs on all these futures can be found on their website. It's really helpful. But as you can see, futures starts trading at 6 p.m. on Sunday night. This is all Eastern time, by the way. Starts at 6 p.m. and it goes until Friday at 5 p.m. Except there is the maintenance window, which is from 5 p.m. to 6 p.m. And so that's the cutoff from going from day trading margin requirements to the maintenance requirements. So 5 p.m. Central Time until 6. That 1 hour window is when, one, you can't trade anymore, and two, you have to have enough money in your account to keep a contract open. So that's just, and this is for the ES. And so you always have to check what the hours are for the type of futures contract that you're trading. So here's an example, just kind of laying it out. So Sunday from 6 p.m. until Monday of 4:59 p.m. Day trading is the margin type that is in effect. And so if you wanted to trade like the ES, the standard, the mini size contract, the margin required is $400 in your account. And then Monday at 5 p.m. until 5:59 p.m. Again, these are all Eastern. Now we enter into maintenance mode. And one, you can't trade, but two, this is the amount of money that you have to have in your account to be able to hold that position if you opened up during the day to hold it. And then right again at 6 p.m., now we go back into day trading margin requirements from Monday 6 p.m. until Tuesday at 4:59 p.m. We're in day trade, and then we just start all over. Tuesday 5 to 6 is maintenance, and just keep repeating that. Keep repeating that every day. So just a little chart there to show that. Okay. Here is a trading example to see how margin affects your account. So let's say you have in your account $5,000. Now, I am not advocating that you only need to have $5,000 in your account to trade futures. And I specifically chose this amount just to highlight what can go wrong if you don't have really enough money to trade futures. But in this example, there's $5,000 and you buy one ES contract. So we know that the day trading margin is $400. So the remaining margin in your account is $4,600. And let's say that you're looking at this chart, you saw this big blast off, and then you're thinking, okay, here's a correction, and now price is going to go back up. So you buy here, expecting a breakout above here, and you buy it when the S&P is at 47.40. So $400 is now taken out of your account to satisfy the margin requirement, and you own the contract at 47.40. And then all of a sudden this happens. Price plummets to 47.20. So you bought it at 47.40, the ES drops 20 points. And remember, the mini contract, it moves $50 per point. So if it dropped 20 points times 50, you're now down $1,000. And so over here, if it's 459, you do not have the required maintenance margin requirement of 11,800, and thus you are forced to close your position and take that $1,000 loss. So in one day, you lost 20% of your account. So that's why I chose this 5,000, just to show that even though you can day trade the ES contract with a $5,000 account, I just cannot recommend it at all, because that's just a 20-point move, which is nothing in the S&P, and you could easily just lose $1,000. And on a volatile day, I mean, the S&P, it could go easily 50, 75 points, which now you're blowing up your account. So I just wanted to show this type of an example of, one, the power of futures, but also you really need to understand how the margin and this maintenance margin works here. Okay. Now let's look at an example of trading the micro contract. And again, we'll start with $5,000. And you buy the MES contract, which has the $40 day trade margin. So now if you buy that, I got this ES here, but on this example, we're buying the MES at 47.40. And so if the MES in this example were to drop 20 points down to 47.20, it's only $5 per point. So you'd be down $100 instead of the $1,000 trading the mini. So now at 459, you do have the required maintenance margin requirement of $1,180 in your account. Because your account value would be $4,900 because you're down $100. So you satisfy the maintenance requirement, so you can remain in the trade. So if you, for some reason, still feel like you want to hold this trade, even though it dropped to 20, you can do that because you satisfy the maintenance. So that's just an example of the power of the mini versus the micro. Okay, expirations. This is another important topic, and probably could even do a whole separate video just on understanding expirations, especially when you look at all the different types of expirations and whatnot. But yeah, so futures contracts have an expiration date. Oh yeah, so it is the cmegroup.com. So you can visit them and you can pull up the specifications on any type of futures contract that you are interested in trading to see all the attributes of the futures contract. Most contracts expire monthly, but the indices like the S&P and the NASDAQ, they expire quarterly. So you can't just buy and hold forever like a stock. You know, these contracts, they expire, and you have to be mindful of that. So if you want to remain in a position that is about to expire, you can do what is called rolling your position, where you sell the current contract that is expiring. So if it's a monthly contract, and let's say the January contract is expiring, you would sell that contract, for a profit or for a loss, and then you just immediately would buy the February contract, or you could buy the March contract or whatever. So you can always do that, roll your position. But again, if this assumes that you have enough money in your account that you can be holding a contract overnight. So you just got to be mindful of the margin requirements. All right, now let's look at some of the differences between futures and stocks. So in the futures world, trading hours, we already went over it, but most are going to be, that Sunday through Friday with a 1 hour maintenance window from 5 to 6 p.m. Whereas in stocks, the trading is Monday through Friday, 9:30 to 4 p.m. Eastern. And there is extended trading hours pre and post market, but the bulk of the volume obviously is just going to happen in this little window here. Day trading. So in futures, there's no pattern day trader rule, which can be really key for a lot of retail traders. Whereas in stocks, you do have the pattern day trader rule. Leverage, big one here. Leverage, it's present due to the margin. So as we looked, like on the ES, you effectively have 20% leverage. It's $50 times the current S&P price, and then you divide that by the margin. So let's say the S&P is at 4,800, so 50 times 4,800, divide that by 11,800, the margin requirement, comes out to 20.33. So you basically have 20% leverage when you're trading like the ES Mini. Now every type of futures contract is going to have a little different leverage, but that just gives you an idea of trading the ES Mini. You're effectively getting 20% leverage, where in stocks you have none by default unless you're playing for a margin account to attain extra capital. Okay, some more differences, and I think these are really big ones. Short selling. So in the futures world, there's no difference to go long than it is to short a futures contract. So to buy a contract, to play for a 10-point move is the same as shorting, because you think something is going to go down. It's a great way that you can hedge by selling a futures contract. Whereas in stocks, if you want to short, you need a margin account, and then you're paying that daily fee to attain that extra capital to short. So I think that is really that's a big one because you can easily be going long and going short in futures. And I really like that. And then the settlement is another really big one. So in the futures world, as soon as you sell the contract or you close the contract, I should say, that money, the profit or the loss, it goes immediately, it's back into your account, and immediately the amount of money that's in your account is available to trade. Whereas in stocks, there's the T plus two. In this May, we're actually going down to T plus one, but that money isn't truly available to trade until the trade settles. So there's that little lag, which can sometimes be a little annoying. But in futures, you have immediate access to your funds, and I really like that. And then the next big one is taxes. So trading futures, your gains, you're taxed at the 60% long-term capital gains rate of 15% and 40% of short-term capital gains at your ordinary tax rate. So that is a big tax savings. Whereas in stocks, you're taxed at your ordinary tax rate. Now, this obviously only applies to all U.S. traders. So if you're going to be trading futures on a European or Asian stock exchange, or futures exchange rather, then these numbers are all going to be different. But yeah, taxes in the U.S. it really makes a big difference. Okay, so how to trade futures, just real briefly. Find a futures broker. Popular brokers in the US are Interactive Brokers, E-Trade, Charles Schwab. This is AMP that I use. NinjaTrader is out there. And then once you find your broker, you just deposit money, and then you need to decide what type of asset you're going to be trading so you can choose which exchange to trade on. So this, like I said before, you got the CME is for like all the stock indices and Forex, and the New York Exchange for the energies, COMEX is the metals, CBOT agriculture, and Dow and financials. So you look into those exchanges for their specifications on margin requirements and whatnot. Okay, so hopefully this sheds some light into futures. And like I said, this just an intro video, really. You'll want to do further research to make sure futures are good for you. So I hope it helps. Let me know if there's any questions. Maybe I can clarify stuff going in the comments section. But I wish you luck. I think futures are a great way to trade. I've been doing them now for 4 years, and I really like them. So hope this helps. Good luck to you all. See you later.